Do you want to buy at the market bottom and sell at the peak? Do you want to maximize your wealth with perfect timing? The answer is simple. Give up on market timing. Adopt dollar cost averaging. Why does it work? This slide explains it all. Look at the SPIVA report from S&P Dow Jones Indices. Over 15 years or more, roughly 90% of professional fund managers underperform the S&P 500. Even professionals can't beat the market average. Warren Buffett said it. Short-term market predictions are extremely difficult. Even the world's greatest investor has given up on timing. Do you notice the critical fact here? Market prediction isn't a skill. It's pure luck. 9 out of 10 professionals fail at it. This isn't strategy. It's gambling. This is a pattern shown repeatedly in decades of market research. This isn't a hypothesis. This is an empirically confirmed pattern. And there's a solution. Give up on market timing. Adopt dollar cost averaging. Invest a fixed amount every month, automatically. This frees you from the trap of market prediction. Today, I'll show you the mathematical proof. So, what is dollar cost averaging? The mechanism is extremely simple. You invest a fixed amount every month, say $500. What happens when prices are high? If the stock is $100, you buy fewer shares. What about when prices are low? If the stock is $50, you buy more shares. In the U.S., brokers allow fractional purchases of ETFs and stocks. Mutual funds generally allow fractional purchases. The structure of automatically buying more or less based on price is the same. Here's the key point. The lower the price drops, the more you're buying. The higher the price rises, the less you're buying. This happens automatically. Your emotions aren't involved. Do you know why most investors fail? They panic and sell during crashes. They buy in euphoria at peaks. Emotions dominate their decisions. Dollar cost averaging eliminates those emotions. The system works. The math works. You make no decisions. You just continue. Here's where the question arises. Lump sum or dollar cost averaging, which is superior? Look at the data. Based on expected value, lump sum tends to be advantageous because markets tend to rise over the long term. So expected returns are higher with lump sum. But that's not the whole story. What if you invested a lump sum right before a crash? From 2007 to 2009, the S&P 500 dropped over 50%. A major drop right after you start increases psychological and financial stress. And this is where most investors give up. This is the true value of dollar cost averaging. It's not about maximum returns. It's about a design you can sustain. Even if your timing is wrong, you avoid catastrophic losses. When the market drops, you keep buying at bargain prices. And there's one more thing. The intangible value of psychological stability. You don't panic during crashes because the system is working. Expected value, lump sum. Sustainability, DCA. Depending on your goals, both are rational choices. Now let's look at real data. A simulation from 2008 to 2023, roughly 15 years and 4 months. September 2008. Lehman shock. The market is collapsing. The worst possible time. Here, you start investing $500 per month. 184 contributions. Total investment, $92,000. And at the end of 2023, your assets are? Just the S&P 500 price index alone, about $215,000. With dividend reinvestment, over $270,000. Let's calculate. Your $92,000 investment became over $270,000. Roughly triple. And in 2024, 2025, the market continues hitting new all-time highs. The S&P 500 broke through 5,000 points, 6,000 points. The people who were waiting for a crash back then are still just watching with their fingers in their mouths. Do you notice the critical point here? You started during a major crisis, in the middle of the financial crisis. Yet if you continued accumulating over the long term, you captured the recovery phase. Why? Not because of market timing, Because time worked for you. Hold for the long term. Accumulate growth and dividends. This time becomes the source of returns. Note, this calculation assumes the S&P 500 Total Return Index with dividend reinvestment. Taxes, fees, and inflation are not considered. Results vary by period and number of contributions. What's the greatest value of dollar cost averaging? Prevention of emotional selling. Do you know the research from Dalbar and others? For years, it's been reported that investors tend to underperform market averages through timing behavior. Investor returns, including fund flows, tend to fall short of market returns. Why? Emotional trading. The market crashes. Fear takes control. Investors sell. They sell at the bottom. The market recovers. Confidence returns. Investors buy. They buy at the peak. This is human instinct, and this destroys wealth. What does dollar cost averaging do? It eliminates this emotion. An automated system works. You make no decisions. You just continue. During a crash, what is your system doing? It's buying at bargain prices. Your emotions feel fear, but your system works calmly. This is the true power of dollar cost averaging. Your greatest enemy isn't the market. It's you. The system protects you. So when should you start? The answer is clear. Today. Many people say this: I'll wait until the market drops. I'll find the perfect timing. This is an illusion. I've already shown that consistently getting short-term predictions right is extremely difficult. Waiting for perfect timing only creates opportunity cost. Let's calculate. You start investing $500 per month at age 25. 8% annual return. After 40 years, about $1.74 million. You start at age 26. 39 years. About $1.61 million. Just 1 year difference. But what's that difference? About $130,000. More than the price of a luxury car. Just delaying 1 year significantly reduces the power of compound growth. You can't buy time. It doesn't come back. But the market is too high, you say. Let me show you the data. In 2023, many experts predicted a recession. But the market went up. Predictions kept failing. Today is the youngest day of your life. There's zero reason to wait until tomorrow. Now, let's organize today's key points. Here's today's summary. First, market timing is extremely difficult. The Spiva report shows this. Over 15 years or more, roughly 90% of professional fund managers underperform the S&P 500. Even professionals can't beat the market average. Consistently getting short-term predictions right isn't a skill. It's pure luck. Second, time is the only answer. Even starting in 2008 during a major crisis, your assets grew 15 years later. Your $92,000 investment exceeded $270,000 with dividend reinvestment. And in 2024-2025, the market continues hitting all-time highs. Not timing, but the time spent holding long-term and accumulating growth and dividends creates wealth. Third, emotion is your greatest enemy. Many studies report the gap between market returns and investor behavior. The reason is emotional trading. Dollar cost averaging eliminates that emotion. An automated system protects you. What are you waiting for now? Perfect timing doesn't exist. Today is the best day. Share your investment strategy in the comments. When you started, what challenges you faced, what successes you achieved. All of it becomes wisdom for this community. Thanks for investing your time with me today. This channel breaks down the trap of market timing, asset allocation, and concrete strategies for financial freedom with numbers. You can achieve financial freedom too. If you want that confidence, hit subscribe. Turn on notifications too. Until next time, keep building.